When a factory in Seoul sells a tanker of electronics to a distributor in Lagos, the physical goods move across oceans, but the legal settlement of the money involved moves through a few specific blocks in Lower Manhattan. This occurs because of two networks, Fedwire and CHIPS. Every weekday, these systems settle trillions of dollars in wholesale payments. They handle the funding for global oil shipments, interest on sovereign bonds, and the collateral for the derivatives that corporate treasurers use to manage risk. This concentration creates a specific geographic risk. A localized power failure, a software error, or a cyber attack at these nodes can freeze international trade in a matter of minutes. Other critical infrastructures, like power grids or airline routes, are designed with built-in redundancies. This financial architecture lacks an emergency bypass. It is the result of an 80-year cycle of solving international crises by creating deeper, more centralized dependencies on the US dollar. This dependency began at the end of World War II. With global commerce ruined, the world needed a stable, universally accepted anchor to restart trade. The delegates at Bretton Woods engineered a solution. They pegged every global currency to the US dollar, and the dollar was pegged to gold. At the time, the United States held roughly 70. This chart shows the primary tension of the late 1960s. Global trade grew so fast that the supply of offshore dollars, often called Eurodollars, completely eclipsed the amount of gold sitting in U.S. vaults. In August 1971, President Richard Nixon unilaterally suspended the dollar's convertibility into gold. The mechanical guarantee of the Bretton Woods system was gone. The world still required a safe asset to store wealth, so savings shifted into U.S. Treasury bills. These securities became the new foundation of the global money system. This transition was cemented in 1974 by the petrodollar accord. Saudi Arabia agreed to price oil exclusively in dollars and invest its surpluses into U.S. debt. In return, Washington provided military protection for the kingdom. By ending the gold link, the United States traded a system based on physical scarcity for a system based on an infinite loop of debt and geopolitical military leverage. Shifting to a debt-based system allowed for an explosion of high-speed, synthetic dollar transactions outside U.S. borders. Processing this massive volume required a technological patch to settle trades, without the slow process of moving physical currency. The private CHIPS network manages this through a netting algorithm. It takes thousands of complex, overlapping trades between banks and compresses them down to their net differences. However, to achieve finality, those net settlements must eventually touch the sovereign Fedwire servers in New York. The technology needed to handle the scale of modern trade created a digital choke point. The entire world's financial metabolism now funnels through these specific servers. This centralized architecture remains stable during periods of calm, but when a major shock hits, the entire system can seize up. In 2008, the shadow pipelines that create synthetic dollars outside the U.S. suddenly clogged. Foreign banks faced dollar shortages that their own central banks were unable to resolve. This chart shows the March 2020 pandemic crash. Notice the sharp dip centered on the March 16th marker. Global investors scrambled for cash so aggressively that the dollar settlement system nearly broke in 36 hours. During a panic, the private market's ability to create dollar liquidity disappears. Everyone attempts to secure physical U.S. reserves at once, creating a massive traffic jam at the New York clearinghouses. To prevent these liquidity jams from collapsing the world economy, the Federal Reserve utilizes a tool called a swap line. In a swap, the Fed prints billions of dollars, exchanging them directly with allied foreign central banks to bypass frozen private markets. This liquidity injection satisfies margin calls abroad, allowing the global settlement grid to resume functioning while private credit remains frozen. Because only the Federal Reserve can print the currency the rest of the world requires to survive a crisis, it functions as the final backstop for the entire international financial system. The dollar has become a shared global infrastructure where efficiency is inseparable from concentrated risk. Since world commerce is now dependent on these specific New York servers, the system's survival rests on the Federal Reserve's capacity to supply reserves whenever the bottleneck jams.